Hello everyone, and welcome to another episode of NRI Arth Gyan. Today, we are diving into a complex but crucial topic for non-resident Indians, NRIs, based in the US, passive foreign investment companies, or PFICs. Now, I know this might sound intimidating, but fear not. We'll break it down into simple terms and explain why understanding PFICs is essential for protecting your hard-earned money. Disclaimer: the information provided in this presentation is for general informational purposes only and should not be considered as tax, legal, or financial advice. It is recommended that you consult with a qualified professional for personalized guidance regarding your specific situation. While we have made every effort to ensure the accuracy of the information presented, we do not guarantee its completeness or applicability to your individual circumstances. The tax laws and regulations related to PFICs are complex and subject to change, so it's important to consult with a professional for the most up-to-date information. We are not responsible for any losses or damages that may arise from relying on the information provided in this presentation. Please conduct your own research and seek professional advice before making any financial decisions. What is a PFIC? Imagine investing in a foreign company that generates more than 75% of its income from passive sources like dividends, interest, or royalties. That, my friends, is a PFIC. It's a US tax law term, and it has significant implications for US taxpayers, especially NRIs. Why PFICs matter for NRIs? There are two main reasons why PFICs matter to NRIs. Complex tax calculations. If you own PFIC shares, calculating your US taxes can become a nightmare. Special tax methods like the mark-to-market method or the qualified electing fund (QEF) election might apply. These methods can result in higher taxes if not handled correctly. Potential penalties. Failing to report PFIC income or using incorrect tax methods can lead to hefty penalties. These penalties can seriously impact your financial situation. Now, the good news is that you can protect yourself from PFIC-related issues. Here are some key steps. Understand your investments, know where your money is invested and if any of those investments qualify as PFICs. Consult a tax professional. An experienced tax professional can help you navigate the complex PFIC rules and ensure you're compliant. Consider diversification. Spreading your investments across different non-passive asset classes such as direct stocks, NPS, FDs etc. can reduce your exposure to PFICs. Explore tax-efficient investment options. There are investment options specifically designed to avoid PFIC issues. I know you might have questions, so let's address some common ones. Can I sell my PFIC shares to avoid the issues? No. Selling your PFIC shares doesn't automatically eliminate the tax implications. While selling might seem like a way out, any gains realized from the sale are still considered excess distributions and are subject to PFIC taxation rules. Here's why. Excess distributions. The IRA treats gains on the sale of PFIC shares as excess distributions. This means they are not treated as regular capital gains and are subject to different tax calculations, potentially leading to higher taxes. Interest and penalties. Depending on the specific tax method used, you may also incur interest charges on deferred taxes and potential penalties if PFIC reporting wasn't done correctly in prior years. What to do instead? Instead of immediately selling your PFIC shares, consider these options. Consult a tax professional. A qualified tax advisor specializing in international taxation can help you understand your specific situation and the potential tax implications. They can advise you on the best course of action, whether it's selling the shares strategically, making a qualified electing fund election, or exploring other tax-efficient options. Mark-to-market election. This election allows you to treat your PFIC as if you sold it each year and bought it back the next day. This can help simplify tax calculations and potentially reduce your tax burden, but it comes with its own complexities. Qualified electing fund election. This election allows you to include your share of the PFIC's income on your US tax return each year, potentially avoiding excess distribution treatment upon sale. However, there are specific requirements and deadlines for this election. Always consult with a qualified tax professional before making any decisions regarding PFICs. They can provide personalized advice based on your unique financial situation and help you minimize your tax liability. Next common question is, what if I only own a small amount of PFIC shares? Even if you own a small amount of PFIC shares, it's important to be aware of the reporting requirements and potential tax implications. While there are some exceptions for small holdings, the rules can still apply depending on the circumstances. Reporting requirements. Form 8621. Generally, if you own PFIC shares, you are required to file Form 8621 with your annual tax return. This form is used to report your PFIC income and calculate any applicable taxes. De minimis exception. There is a de minimis exception that exempts you from filing Form 8621 if the total value of your PFIC shares is $25,000 or less on the last day of the tax year, $50,000 for joint filers. However, this exception only applies if you have not made any elections, like QEF or mark-to-market, and haven't received any excess distributions. Tax implications. Excess distributions. If you sell your PFIC shares, even a small amount, and realize a gain, it could be considered an excess distribution. This would trigger the complex PFIC tax rules, potentially leading to higher taxes. Interest and penalties. Even if you qualify for the de minimis exception, failing to report your PFIC ownership or using incorrect tax methods could result in interest charges and penalties. What to do? Track your investments. Keep track of all your foreign investments to determine if any of them are PFICs. Even small holdings can add up. Consult a tax professional. It's always best to consult with a qualified tax advisor to understand the reporting requirements and tax implications of your specific situation. They can help you determine if any exceptions apply and guide you on the best course of action. Consider your options. Depending on your circumstances, you may want to consider selling your PFIC shares, making a QEF election, or exploring other tax-efficient strategies. A tax professional can help you evaluate your options and make informed decisions. Key takeaway: don't assume that owning a small amount of PFIC shares means you can ignore the tax rules. Be proactive in understanding your investments and seek professional guidance to ensure compliance and minimize your tax liability. Another popular question is, are there any exceptions to the PFIC rules for NRIs? Yes, there are a few exceptions to the PFIC rules that can apply to NRIs, offering potential relief from the complex tax calculations and reporting requirements. 1. De minimis exception. Threshold. As we already know now, if the total value of your PFIC shares is $25,000 or less on the last day of the tax year, $50,000 for joint filers, you might be exempt from filing Form 8621. Conditions. This exception applies only if you haven't made a QEF or mark-to-market election, haven't received excess distributions, and don't have an interest in a PFIC through another PFIC exceeding $5,000. Relevance for NRIs. This exception can be particularly helpful for NRIs who have small investments in foreign mutual funds or other PFICs. 2. Startup companies. Newly formed. If a PFIC is a startup company, less than 2 years old and meeting specific criteria, it might be exempt from certain PFIC rules for a limited time. Relevance for NRIs. NRIs investing in newer foreign companies might benefit from this exception, as it provides a grace period for the company to establish itself before PFIC rules fully apply. 3. Certain pension plans. Foreign pension funds. Some foreign pension funds might be exempt from PFIC reporting if the income earned by the fund is taxed in the US only upon distribution to the US person, as per a treaty. Relevance for NRIs. NRIs who have invested in foreign pension plans including NPS might be exempt from PFIC reporting, depending on the specific plan and treaty provisions. 4. Mark-to-market election. Simplified calculation. While not a complete exception, the mark-to-market election can simplify the tax calculations and potentially reduce your tax liability. Relevance for NRIs. This election can be beneficial for NRIs who have PFIC investments that have appreciated significantly, as it allows them to spread out the tax burden over multiple years. Understanding PFICs is crucial for NRIs based in the US. While it might seem overwhelming, taking proactive steps can help you protect your financial future. Remember, seeking advice from a qualified tax professional is essential. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel for more financial tips.